Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden meanings in financial reports. It's almost like reading a company's diary. Today we're diving deep into Globalstar's latest quarterly report to see if their satellite business is finally reaching for the stars or if it's stuck in orbit. Before we launch into the details, if you love getting these clear and simple breakdowns of complex financial documents, make sure you hit that subscribe button. We're always looking for insights, and our Discord community is a great place to keep the conversation going, so check the description for an invite. Alright, so Globalstar just dropped their financial report for the quarter ending June 30th, 2025, and it's a mixed bag. Let's break down the numbers. First off, total revenue jumped to $67.1 million. That's up from $60.4 million the previous year, which is a solid 9% increase for the first 6 months of the year. They're bringing in more money, which is always a good sign. Diving into that service revenue, which is their main bread and butter, it went up to $63.2 million from $57.6 million. This increase is largely driven by their wholesale capacity services. This is interesting because it means their big clients are using more of their satellite network capacity. But not everything is soaring. Spot service revenue actually dropped a bit. It went down to $9.2 million from $10.4 million last year. This might be due to fewer customers using their spot devices. Competition is tough out there, and they're even thinking about a new consumer spot device to maybe boost things. Now let's talk about costs. These guys have a lot of expensive satellites and ground equipment. Depreciation, amortization, and accretion. That's basically the cost of using up their assets went up slightly to $23 million for the quarter. Overall, operating expenses actually went down a tiny bit for the 3-month period. It seems they're managing their costs even as revenue grows, though the 6-month period saw a slight increase in expenses. All this boils down to their operating income, which was positive this quarter at $6.1 million. That's a big improvement from a loss of $1.4 million in the same quarter last year. This really shows they're becoming more profitable from their core business, and the bottom line net income for the quarter was $19.2 million, a huge swing from a net loss of $9.7 million last year. This is a significant turnaround, folks. Now let's look at their balance sheet to see their financial health as of June 30th, 2025. They have $308.2 million in cash. That's a good chunk of change, though. It's down from $391 million at the end of last year. This drop is mainly because they're investing heavily in new projects. Their property and equipment went up dramatically to $900.8 million. That's a big jump from $603.6 million, and it signals major investments in their satellite and ground infrastructure. This lines up with their plans for new networks. Total current liabilities are $129.2 million, which is manageable. Long-term debt stands at $468.8 million, a bit lower than last year. This is good. They're managing their debt load, and their total stockholders' equity is $360.8 million. That shows their net worth after accounting for everything. Let's peek at their cash flow statement to see where the money is actually coming from and going. For the first 6 months of the year, they generated $2,009.7 million from operations compared to only $66.5 million last year. That's a massive improvement. The report says this is partly due to getting $124.7 million as an advance payment for future services. This is like getting paid upfront for work, not yet done a good cash boost. On the flip side, investing activities show they spent a lot of money, $271.8 million this year compared to $74.5 million last year. This is mostly for building out their new satellite networks, including payments for satellites and launch services. That big Apple deal is clearly fueling a lot of this investment. Financing activities show they used $22 million this year compared to getting $16.2 million last year. This likely reflects how they're managing their debt and paying dividends. Going back to revenue, the big story is the increase in wholesale capacity services. This is heavily tied to that upgraded services agreement with Apple. They're getting paid more by Apple for using their infrastructure and for expanded services. The decline in spot revenue is a slight concern. It shows that while their big client relationships are strong, their smaller consumer products might be struggling against competitors. Their cost of services went up slightly. This is likely due to higher network operating costs as they upgrade their global ground infrastructure. But remember, a good chunk of these costs get reimbursed by Apple, so it's not all bad news. Stock-based compensation expense decreased, which means they spent less on stock options and similar rewards for employees. It was 12.9 million compared to 18.4 million last year. They also reported a healthy foreign currency gain of $16.1 million. This indicates that the currencies of the countries where they operate have strengthened against the US dollar, which is a nice financial boost. The cash flow from operations is really the star here. The jump to 29.7 million is phenomenal. This is driven by customer prepayments and strong wholesale revenue, which gives them a lot of flexibility. Their massive investment in new infrastructure is clear from the $271.8 million spent on investing activities. This is a long-term play to build out their next generation network and support that crucial Apple deal. It's also worth noting that they're actively managing their debt. They repaid some principal on their 2021 funding agreement, which is a good sign of financial discipline. Overall, Globalstar is showing real signs of progress. Their revenue is up, their operations are more profitable, and they've got a solid cash flow, mainly thanks to that major customer deal with Apple. The big investments in new satellite networks are a gamble, but one that seems to be paying off so far. However, they do have some risks. The reliance on a single major customer like Apple is always a potential vulnerability if that relationship were to change. Significantly, it could dramatically impact their business plus the spot service. Revenue decline means they need to keep a close eye on their consumer offerings and adapt to the market. Looking at the big picture, Globalstar is clearly focused on building out its future satellite network. This means heavy investment now for potentially larger returns later. They are a company in transition, moving towards a more robust and expanded service offering. So what's my take? Globalstar is making smart strategic moves by securing those large customer contracts and investing in future technology. This is a company that's building for the long haul. The turnaround in profitability is impressive, and the strong operating cash flow gives them the resources to execute their ambitious plans. The key will be continued growth in their wholesale business and a stabilization or growth in their other services. Alright, that's our deep dive into Globalstar's latest report. What do you think about their strategy and financial performance? Let me know your thoughts in the comments below. If you found this breakdown helpful, hit that like button. It really supports the channel. And of course, subscribe for more corporate insights. Don't forget to join our Discord community linked in the description for more discussions. Thanks for watching, and we'll see you in the next Decode.